Economists have so far suggested that South Africa should tweak its macroeconomic policy to focus on employment, growth and financial stability. The country's Reserve Bank has used inflation targeting for 14 years and has allowed the exchange rate to act as a shock absorber. Economists argue that monetary policy should look at financial stability and needs to focus on capital flows and the exchange rate. Earlier, SABC spoke to Xhanti Payi, an emerging markets economist and lead researcher at Nascence Research Institute. We started by asking him about South Africa's current inflation targeting policy.
Inflation is quite a bad thing in any economy. You can never allow inflation to take root because it actually takes away people's efforts. So whatever we earn, if it gets taken away by inflation because prices keep rising continuously, people start being disengaged from working or being productive. So you don't want a situation in which inflation escalates and runs away with you. You want to always keep it sort of anchored, which is the word the Reserve Bank likes to use. So on that level, it's very important, and we need to actually find a way to keep inflation stable. But at the same time, our policy of inflation targeting, this debate has been going on for quite some time now, probably since we instituted the policy. And the main issue here is whether or not the instrument that we have actually works and it meets what we are trying to do. So in South Africa in particular, what we've had in the past few months has been inflation that comes from external factors. So it isn't anything. Remember, inflation targeting in South Africa, we use interest rates. And interest rates actually are directly meant to influence domestic expenditure. And if your inflation is not coming from domestic expenditure or people actually overbuying and therefore hiking prices, and it comes from external factors such as U.S. monetary policy or issues in the UK or Europe, then inflation targeting becomes quite a blunt instrument because suddenly you are using this instrument almost to change something that's not. And some people have said, it's almost like when you are holding a hammer, every problem's a nail. And I think that's the problem we have with it, that we need different instruments to work along with that. And I think we've always argued at Nascence that the idea is to actually do something about the rand in particular, because it's the one thing that actually almost disables monetary policy from working.
And just quickly touching on what you were saying earlier on about this debate around the country's policy. It has been a debate that's been continuous. You have, for instance, Treasury, and you've got government on one corner, and then on the other side, you've got the unions. COSATU has been very vocal, saying that this is not the way to go.
Yeah, look, I think that everybody has some vested interest in any particular policy. Certainly, COSATU has been changing their stance over time. There was a time when they said, South Africa must do something about the rand, about inflation targeting, and certainly the rand must be allowed to weaken to a particular level. And the rand has actually weakened since. I think the debate started when the rand was around 6 rand to the dollar. It's now nearly double that, and we're still having the same particular stance. So certainly, we need a more nuanced debate around that. And I think for me, what we need to talk about is what level of the rand is important, and therefore, for inflation targeting. So inflation targeting is important. COSATU cannot obviously claim that inflation would be a good thing in this country because it would eat directly at the earnings of the worker. So, it is something quite important. I think the debate now needs to be a little bit more nuanced around how do we actually achieve that end while targeting inflation.
And speaking of a weaker rand as well, we saw the rand weaken to about 11 rand to the dollar. Who benefits out of that? What does it mean for export? What does it mean for the country's imports as well?
Yeah, look, the rand has weakened consistently, and we would have liked to see at least exports benefiting from that. But the problem with that is, the rand represents really the prices of South African goods to international buyers. And the problem with that, though, is that, the international buyers have been quite struggling in their own problems in their own economies. And so the problem is not so much the price of South African goods, but actually the demand, or at least the buying power of international trade partners. And that has been the reason why we haven't seen the pickup. But certainly a weaker rand does bode well for South Africa and for South African goods and services in the export markets. And as things start to change a little bit, we should be able to benefit from a weaker rand. But obviously, South Africa has a big plans to try and build infrastructure to make sure that, our roads and ports are built so that we can actually benefit from the economic growth that comes with that. unfortunately, a weaker rand is not good for that because we import much of the capital goods that we need. And so as the rand weakens, it makes it very, very expensive to be able to actually import those goods. And I remember there was a debate even with PRASA where they were saying, you know, they have a 50 billion rand to put out in one phase of the development of infrastructure in the rail sector. But they have to put in about 3 or 4 billion, I think it was, or maybe 2 billion it was, just as a buffer for the rand. Now, that until now, from that time to now, the rand has probably weakened over 5%, which is more than they actually bargained for. So these are really negative spill-offs from a weaker rand, which means that we need to do something more about not so much the level, but how we actually stabilize the rand so that we can make sure that we can plan better, both as importers but also as exporters. You know, business people want to be able to plan for a rand rather than to keep reacting to a level.
And you're speaking about greater exports, and greater exports basically mean that there's a lot of demand for more businesses, and more businesses obviously means that more jobs, more people get employed. And analysts have been arguing that there should be a greater or much more push towards promoting these small enterprises to really work towards unemployment and work towards economic growth. Do you think that's the path to go, considering as well that government, the president actually recently announced the establishment of that new Ministry of Small Businesses?
Certainly, I mean, that is what we need to do most importantly, because it turns out that big businesses, you know, the big listed businesses don't create as many jobs in the smaller businesses, you know, because obviously at some point they tend to be more efficient, and by efficient they need less people and they use more machinery and technology. Whereas the smaller businesses, you know, at the beginning are very absorbent of labor. So that is really what we need to be able to create a more vibrant economy and, you know, increase competition and allow people to access work. And obviously over time we want those businesses to be strong enough to compete internationally. Again, the rand comes into this, and that's why the debate on the rand is very, very important, on finding ways of stabilizing the rand in one way or the other. And I think most people who are engaged in this debate are saying we need to work on stabilizing the rand more than anything else.
And just quickly, the G20 summit saying that 2% economic growth over the next 5 years. Do you think that South Africa is capable of doing something like that?
Look, I mean, it's very disappointing. I think that, you know, it's a targeted, or it's an outlook that, you know, is very disappointing, that we should be looking for far more. I mean, 3 times that number probably, to be able to, you know, to at least make a dent on unemployment and poverty in this country. And so 2% is not a number we should be looking for. Again, you know, there's been a number of 6% that's been thrown around for quite some time. There was a point we were able to reach close enough to that and create some jobs, and we need much more growth than that. Again, it's about how we do the right things over the next few years to be able to actually to grow at much more numbers than just 2%.
That's all we have time for on the news at 8.